I'll get started by introducing my guest today, my collaborator, Nish Patel of Paperchase. So Paperchase is so deep in the books of restaurants. It's so exciting to talk to you because all you do all day is restaurants and their books. And so you know the nitty-gritty of where people are making money, where people are losing money, what they can do to add a couple of points to their bottom line, which we know is a struggle these days, every day. And so I got a million questions for you that my clients always ask me. And I always say, ask a bookkeeper or an accountant. So now I can actually do that with you here. So welcome, Nish.
Thank you, David.
Let's put up the slides. We've got, this is really more like a podcast, but we've got a bunch of slides. So the title of today's webinar is Essential Legal and Accounting Tips for a Successful Restaurant Opening. It's not really just for an opening, though. It's for operating, and it's for all operators for as you're moving along in the industry to know how to watch your costs and how to save money and how to increase ultimately your profits so you can make a living, which we all know is getting harder and harder to do. I will ask and request that if anybody has any questions during the course of the webinar, you can just put them into the chat box if I find them relevant, or if we're not just about to talk about that thing, I will absolutely stop and ask the question. So feel free to ask questions along the way. This is a legal disclaimer. I will give you 5 seconds to read it. 4, 3, 2, 1. Basically, this is not legal advice. It's not accounting advice. It's not bookkeeping advice. It's really just informational. Okay. Let's talk about, Nish, one of the first things that we talk about. And when people come into our office and they say they want to open up a restaurant, I always kind of give them a little bit of a stress test. I say, well, what kind of restaurant do you want to open? How many seats? Where? And what's your budget? And this lets me know if people are sane or not. I've had people come in and say, I want to open up a 150-seat restaurant in the village with a 4 a.m. liquor license, and I've got $150,000 to do it. And I tell them to leave and to go talk to somebody about putting a business plan together. So I know you guys work on business plans all the time. It's really the blueprint to everything because everyone wants to know, investors want to know, banks want to know, your partners want to understand that you, as an operator, have some financial clarity. And budgeting is really crucial to this. So when you're working with new clients, how do you help them build what I would call a realistic financial projection, especially in the first year?
Absolutely. David, first of all, I'm really excited to be here with the crew from Helbraun Levey. When accountants and lawyers team up, you know it's serious. And accountants keeps your money straight and lawyers make sure you don't lose it. So super excited to be here and thank you for facilitating it. To go into your questions, how do we help building the realistic financial model? That process does not change whether you are QSR or a fast casual or overall fine dining, business opening. So key is getting the basics done in a right manner, and that starts with overall what would be the right number of covers they will do it every day, what is going to be the right average check, what will be the composition of that average check is going to be the key.
So a lot of restaurateurs can do this on the back of a napkin. That's how I figure out what kind of income, or at least gross, that a restaurant can do. It's the number of covers times the number of turns, right? Times
Yep,
check average
yep.
times the number of, right. And then you have to make sure that their build out's going to be right. They can have the number of seats they want. Where do first timers go wrong in that calculation?
Yeah, so I think we have done thousands of restaurants financial models, and every single one starts with, okay, let's just assume we are going to be full every night, which is not the case. And that points me to the point when they do the projections, they say like, let's say hypothetically they will do $100,000 a week. They probably assume we will have 50 weeks sort of overall business in a year to do this. However, from our side, we try to do it around 43 to 44 weeks. And that 6 weeks of delta, it's a big delta where you can go down $600,000 in bottom line. That's where they go wrong when they do the projections. Like, okay, we will do $100,000 a week and we will end up having a $5 million restaurant.
So you, instead of projecting out over 52 weeks, you project out over 42 weeks?
Yeah, around 44 weeks because you take weather into factor. Like this weekend is a good example, right?
Hmm.
Like exactly you mentioned, people end up canceling the bookings and reservations. Then you have sports, politics play a big role depending on what cities you are in, especially if you are in Washington D.C. as an example, or there is a United Nations happening. The entire east side is a struggle with getting people in the door. So we do like around 44 weeks as a right conservative model to calculate the true break even as well.
Wow, that's really interesting. I've never heard of anybody doing that, but it makes perfect sense because there are so many dead days and you get to build them in. So that's a realist, sounds like a realistic way of handling that.
Indeed, yes. And I think the example what I gave, that $600,000 loss suddenly bottom line, so, break your neck, right? In a way. So being like very thoughtful about what is realistic, what is the average check composition. When they open, they say like, oh, we're going to do 35% beverage and 65% food, and suddenly it's 70% food and 30% beverage. That also creates starts creating delta overall.
So how do you, if somebody comes into you and says, here's my idea for an all-day brasserie, and I think I'm going to be doing 60% food, 40% liquor, do you correct them based on what you've seen in the industry?
Yes, absolutely. We correct them based on the benchmarking what we have from our experience. And we tell them like, okay, this 60% looks low, it should be 65%, so that they create the model in a right manner.
It's very interesting. When first timers or anybody's building out a new restaurant, one of the big questions that's asked of them is how much is it going to cost? How much is it going to cost all in, hard costs, build out, etc., soft costs, professionals, architects, accountants, lawyers. Um, how do you predict that? How do you come in and say, tell me what you want to do, and here's what I think your budget should be?
Yeah, so let's say if it is going to be New York, we basically look at the concept first, whether it is fine dining, QSR, and based on that, there is an average range of per square feet construction cost which goes into it. Uh,
Hmm.
that defines like to your point, hard costs and soft costs. How big is their wine menu is so that we know it's going to be a huge inventory uplift. So they
Hmm.
should have a good working capital set aside. And if it is fine dining, then they should have enough money for the 3 months of rent plus 3 months of labor.
What are some typical per square foot dollar amounts that you plug in?
Yeah, so we have actually a couple of clients who are opening near Flatiron, and per square feet cost is goes around like $1,400 per square feet. But if you are like QSR fast casual, then that number can go down all the way to $600 too.
So if it's $1,400 a square foot, you take the number of square feet, you multiply it times 1,400, and that's your all-in budget.
That's your hard cost.
That's your hard cost.
The hard cost. Then
Then,
you have labor, pre-opening task force, which you need to build up, and then you add inventory. and your working capital for at least 3 months in the bank when you open the door.
And how do you calculate the soft costs? So hard costs, you have a formula. Is there a formula also for soft costs?
So formula for soft cost, it's somewhere around 30% of the hard cost will be your requirement.
I see. So if your hard costs are 1 million,
Mhm.
you add another $300,000 for soft costs.
Correct,
And
yes.
that's a legitimate budget. Now, we hear the stories, and I've seen them firsthand, of people who are underfunded. And maybe they do the calculation the way you say, but then they fall short. Do you like to add a contingency to someone's budget? So if it's 1.3 in this case, do you then add a certain percentage on top of that?
So that generally gets defined on the middle of construction phase. What sort of change orders they are going through? Are there going to be any delay? And a good example is, let's say you are supposed to open in August, which is a perfect time to open before you get busy in the season. And for whatever reason, they did not get approval from fire or from gas.
Hmm.
They are ready to open in November. Now you don't want to open in the middle of November because you're again going to go into December, January. So that changes like sometimes in the month of April or May that hey, we will require a more capital because of you will be adding additional cost of the delay.
I understand that, but when we're raising money to do a new project, we have usually one shot to raise the money, and it's before we start construction because we never want to go back to our investors and say we're a little short.
Mhm.
So my question is it smart or safe on top of this example of the 1.3 to add a contingency of 10% or 20% or something?
Mhm. It is definitely safe to raise the money, but from the experiences what we had, restaurants struggle to get any contingency in from investors because they like to see like, okay, this is what we're going to live up to the project value, uh,
Mhm.
and that's what they have to sort of deliver.
Okay. Well, then I'm going to chime in and say add 10 to 20% on top because
Absolutely.
it's very hard to come in on budget. It just is. Okay. When you're talking about investors and we're approaching them, so now we've got a budget, we've got our, fluffy part of our business plan. This is what we're going to do. This is our menu. This is where I've worked. What are they looking for? What have you seen investors looking for as far as returns? And what are they looking for in projections of how quickly they're going to get their money back?
Yeah, so we have seen fast casual is somewhere around like 17 to 20% in terms of rate of return. Bars are generally higher. They are around like 22%. And full service slash fine dining is around 12 to 15% range. That is a typical expectation. That number used to be bigger before, I would say 6, 7 years back when you used to open the restaurants because of the labor economics and overall inflation as well.
And in terms of time, because usually investors are like, sure, I'll give you $1 million. How long is it going to take for you to repay my investment?
Yeah, so it's generally around 4 to 5 years now. That time has been extended slightly versus what it was in the past.
And in the past, the way we've always advised clients is investors are looking to 3 years, and that was the magic number. And now
Correct.
at 4 to 5 is much more realistic, takes a lot of the pressure off.
Correct.
Are there some ways we know as attorneys, I won't say what they are until you tell me what yours are. Are there ways to entice investors to invest, meaning a way to return their capital faster? So it's not just 4 to 5 years, it's 3 to 4 years, or it's a little bit faster, and it's not just based on their equity percentage in the company.
Yes, there is a way to entice investors to invest faster, especially if you are a fast casual or QSR side of the mode, and even in fine dining. Uh, uh, Assume we are opening in New York, and then the second restaurants can be opening 18 months down the line in LA, or the lease gets signed. Then they can see the growth is going to come in into multi cities and possibly in Dubai or even in Saudi. That
Mhm.
makes them excited that this is going to be a journey, what they want to be part of it.
Mhm. Another way to do it, just from a purely economic standpoint, is to offer your investors a larger portion of the profits until they're repaid. We do this all the time. So, for example, you're raising $1 million, you are offering 30% of the company for that $1 million.
Mhm.
Typically, that class of investors would get 30% of the profits. They own 30% of the company. But what we do to entice them to give us their money is we say, you know what, we're going to give you 70% or 80%, all the
Yeah.
way to sometimes 100% of the profits until you get paid back. And then once you get paid back, we're going to go back down to the 30%. Investors love this. We call it a flip, and they get very excited by it because it really motivates the operator also to pay back those investors quickly because they're waiting on this big chunk of money in profits that they've been really giving up.
Yeah, no, definitely. I think a profit flip is it's a great vehicle to structure those deals in order to raise money and sell the idea.
Before we leave this one, I'm going to ask you this probably on every section. What is the most common budgeting mistake that you have seen amongst first-time operators?
What is the first common mistakes which we have seen? I think key is not understanding the city well. If you're coming from London to New York or New York to Miami, I think not understanding the dynamics of, what are the down season, what are the up season, and how does the locals react to a particular concept. And based on that, not able to do a right due diligence. Giving an example, if you're going to Miami and you end up opening, let's say, 500-seat restaurant, and you will assume people will come and party every single day, that's not going to happen
Mhm.
just out of the opening. So I think that is really more of research, what competitor is doing, how the city is behaving to outsiders opening into it will
Mhm.
be the key.
And before one last question, I do want to talk about break even. We hear that term a lot. What's your burn rate? What's your break even? How do you define break even? How do you figure it out? And what does it mean? What does it mean to break even?
Yeah, so break even means you are not making any profit or loss in a simple language from an accounting perspective. And the way to do that exercise is you define your perfect average check, which includes your food, wine, liquor, and then you have your theoretical cost of your food based on the menu, which you are putting it on the table.
Hmm.
And that defines, let's say, hypothetically, your food cost is 30%, your wine cost is 25%, and your liquor cost is 20%. Based on that, you get to your gross profit, then you get to your wage cost, which again depends on how many stations you have. Do you need a prep cook at 6 in the morning or 8 in the morning? And that helps you calculating your true hourly labor. And then what management team you require in order to open the place, and then rent, operating expenses, everything comes into the play, which defines the break even. So once you have a break even, the managers or the operating team has like, okay, we have to do every week $100,000 to make sure we are not losing the money, and that becomes their benchmark to decide how they want to seat the people or staff on individual days.
And when you're talking about break even, do you talk to operators about a break even for the year, for the month, for the week? What's the best way to look at that?
So first we do it annually and then we back it out into monthly because seasonality plays a huge role and also your concept in general, right? Whether you are a sports oriented or you are a fine dining or you are a sort of a luxury side of the world. So then we go into each of the month and then we define it in some complicated businesses where they are like supposed to do $10 million plus in revenue. We like to do it weekly break even as well.
Hmm. Makes sense. Okay, great. Let's move on to the next topic. I actually could have stayed on that one for the whole hour, Ash, because there's a million more questions I have.
Mhm.
But let's cover some other things. Company setup. Lawyers like LLCs. Everybody does LLCs now. Lawyers like them because they're easy. It's easy to draft. You don't have to do biannual statements. If you want to pay somebody who's a member of your LLC more than their equity percentage, you can do it. It's a lot of flexibility. I'm wondering from an accounting standpoint or a bookkeeper's standpoint, what do you like? Do you like LLCs? Is that really what we should all be doing?
Yeah, we definitely have seen exactly what you mentioned is we have seen 90, I would say 5% plus LLC in terms of a formation. That just makes it easy from, like you said, a lot of tax benefits, which flows into the personal tax returns and K1s. So that is a generally accepted vehicle for all the businesses.
Okay, great. So we're on the same page there. And within the operating agreement, which is basically the partner agreement. We call it an operating agreement for the LLC. There's some things in there that we always are curious about, and we wonder what accountants and bookkeepers think about them. One of them is profit distributions. Everyone's excited to say, let's distribute profits every month, let's do it every week, let's do it every whatever. And I think people have to be careful with their profits because you want to save some for a rainy day and you also want to be conservative with them. So if you were drafting an operating agreement, typically, how often would you have a member distribute profits?
Yeah, no, great. I think great question and very, very relative for investors too. So we generally like to break this into two parts. First, we like to have profit distributed every quarter and not weekly or monthly because it's not like a stock market, right? As a figure of speech.
Hmm.
And within that, we like to put some sort of a caveat that minimum cash balance have to be X. So you don't end up wiping the entire profit when you're entering in the summer. So let's say we are in October right now. So we should go ahead and distribute profit for June quarter, depending on a minimum cash balance. So you always can true up on a busy season, you have more cash. So you go into January, you are distributing accordingly.
And how do you figure out what that minimal cash balance should be? That's an important number for people to know, isn't it?
Yeah, so I think that goes back to what we discussed earlier is overall 3 months of rent and 3 months of your monthly average wage cost can be a good benchmark to keep that we should keep this money in the business because also David, it depends on what are the aspiration of the business and the investors. Do they want to grow the brand? Maybe they are in a journey 1 year down the line that hey, we should open in Vegas or in London, and for that we might have to hire a director of operations. So we don't want to just take all the cash away and which can strangle the business to grow in the future.
So it's important for an operator to talk to their investors and strategize as to how they're going to use their profits. Because if you're going to build a hospitality group, which everyone's doing these days because mom and pops, at least standalone mom and pops are dead, and you have to build that infrastructure, a DO, GMs at each location, a wine director, et cetera, a CFO, you might want to keep those profits in the company, right? So it's important to talk to your investors and come up with a strategy so they know what's what.
Absolutely. And I think what we generally suggest to the chefs or a managers or a beverage director who are opening their first restaurant and raising a money from investors. they should definitely write 1 page or 2 page quarterly, sort of an owner or, a chef, update. How do they see the business? What is their strategic vision going into the future? And that will help align everyone on the 1 page, and also put all the thoughts very clearly on a 1 page or a 2 page document, which we call it a management commentary.
I will tell you that I've been in the middle of so many investor operator problems, and so many of them could have been avoided if the operator just communicated to the investor group. I think once a quarter, sorry, is a great idea. Here's where we are. Here's what we're doing. Here's what's going on. Here are the P&Ls for the quarter. Everybody's happy. And too many operators forget to do that because they're busy and it's understandable, but investors get pissed and they do not like to be kept in the dark. So I really like that idea of a one pager along with the P&Ls.
Yep, absolutely. And I think cash flow is the key, right, in this entire thing. When you open a restaurant, everyone tells you follow your passion. But at Paperchase, we gently remind them that follow your cash flow too at the same time.
Nice. Some operating agreements have buyout provisions, meaning that a GM and a chef go into partnership together. The GM starts to not show up to work, got to buy him out. Have you, and oftentimes we don't do this, but I've seen it a lot. There are provisions in the operating agreement that call for a valuation of the business.
Mhm.
And we like to get ahead of that. So, do you see any, or do you have any tips for operators on how to value a business when they have to buy out a partner?
Yeah, we see this often, and that's always a burning point because one of the investor might not be aligned with the vision what the restaurateur has. Uh, so I mean, we call it a quality of earning, which we want to get it done. And based on that, you decide the fair value. You look at again the cash flow, and then you propose them to buy out, the shares back, which is where you come in and help drafting the agreement, which works in their favor.
So you do, is it a multiple of cash flow, or what's a typical way to have a sane and rational valuation of a business when you're buying someone out? Because, the future is uncertain. So we might be doing great in year two and have 8 years left on our lease, and then COVID hits, and then the landlord's difficult. Then we have a Hurricane Sandy, and everything goes down the tube. So how do you figure that out?
Yeah, so for restaurants is generally more difficult, but typically it is based on EBITDA. That EBITDA would give you the right indicator, and second one is going to be how quickly you can grow the business in terms of cross city and the cross countries. So
Hmm.
between those two, we define quality of earning, and then we define enterprise value or equity value, and propose that okay, this is the value of your shares, and then you have tag along rights in the OA, which you can use it to buy the other investors out.
Okay, that's good. Let's talk about the lease for a second.
Mhm.
Looking for spaces, that's a whole other webinar on its own. So we're not going to talk about that. But, we've heard this number forever. I'm 40 years in the industry now, and it was always 10%, 10%. Your lease can't be more than 10% of your gross. Is that still the right number?
Yeah, that's the magic number, 10%. In many cases, we have seen, but those are like once you have a successful outpost, that number can go down to 8%, where the landlord really wants you in your space. So it can go down even less than 8% for fine dining places. For QSR, that number can be slightly higher because your wage costs are tend to be lower than fine dining.
Hmm.
It's okay to go up to 12% to 14% for QSR.
Well, that's interesting. 12 to 14 for QSR, huh? When you're thinking about this 10%, this 8 to 10, I like it at 8 personally, but are you considering additional rent in that calculation? Because we're paying a portion usually of the taxes, usually maybe there's something else to pay. Do you consider that as part of this 10%?
Yes, we consider them as a part of 10%, but if you are at a, let's say, 7% rent, you probably would have another agreement that minimum 7%. But if your revenue goes more than 10 million, then they will pay additional X percentage on top of it. So we take that blended rate, but overall it should not be more than 10%.
Hmm. And do you have an opinion on something that kind of started to get popular during COVID, and we're still seeing in some leases, and that's just a straight percentage rent?
That's the best one to have for sure.
Why is that?
It reduces your overall break even. Sorry, not break even. Your working capital requirement when you open, because the rent only kicks in when you open the doors. So it becomes variable cost and not a fixed cost on the P&L, which eventually also reduces the stress on the break even.
Got it. Okay, let's talk about registrations and permits. Um, we all know that restaurants are heavily regulated. We have federal filings, we have sales tax, we have liquor licensing, health permits, on and on. And we
Mhm.
want to make sure that we're set up the right way from the start. So, from a bookkeeper and accountant's perspective, where do people go wrong? And what is the order of business for them to set up their sales tax correctly and their IRS filings correctly?
Yeah, so sales tax and liquor license, they sort of starts on, sort of together. And typically you should start applying for it at least like 6 months before you are about to open, because you can't have one with others. So you need sales tax as a first, then you get the liquor license, also need to happen. And IRS filing, it's pretty straightforward because you would have LLC created. So first tax return might not even have any operating activity. So it'll be a nil filing in terms of the profit. We just show the assets and then we can file that. So that one is relatively simpler if someone has created an LLC in the month of March, April, May, June, and they're opening in a following year.
Hmm. And talk to me about EINs. We get asked to do it all the time. We always say no. Is it important for the bookkeeper or the accountant to file for the EIN? Can our clients just do it themselves?
Yeah, so it's a relatively easy process. It doesn't cost a fortune, so bookkeeper can easily do it or an accountant. We also take care of that for our clients. But it's not a difficult process. It probably takes like 48 hours to get the EIN out.
Okay. And what about the sales tax? There's a certificate of authority, it's called, to collect sales tax. How does that work?
Yeah, so you have to register. So once you did EIN, you have to apply for the sales tax. Again, let's assume that this is going to be New York. So you apply, you provide the social security of the key person, individual, and then that is also a fairly easy process.
Moving along through the course of operating a restaurant, oftentimes our clients get into a jam and they can't pay their sales tax. Now,
Mhm.
sales tax, the way the state looks at it is they're giving you this certificate of authority to collect it for them. And you are just holding it for them. They're giving you their trust that you're going to take the sales tax, hold it for them, and then give it to them. So there's a lot of rules and regulations around it, and you can't just blow it off. But sometimes we don't handle it well. How do you suggest, as we're going along, that we save for sales tax? And what happens if we fall short? How do you suggest dealing with that?
Yeah, great question. And this is where people definitely go wrong. So the way we advise the clients when they open the restaurant is they should open four bank accounts: operating account, or which we call it a checking account. Second is payroll account, where your payroll gets debited. third is a sales tax account, and fourth is a revenue account slash investment account.
Can you say those four again, please?
Sure. First is operating and checking account, where
Mm-hmm.
you pay all the suppliers on a day-to-day basis.
Mm-hmm.
Second is payroll, where you pay all your employees every week or bi-weekly.
Mm-hmm.
Fourth is a sales tax account, which I will go into answering your question. And fourth is the revenue account, where your Visa, MasterCard, Amex money actually comes every day from your point of sale. So the process which we like all the restaurateurs to follow it is every Monday they should transfer the sales tax collected from the revenue account to the sales tax reserve account, and they should not look at that account as part of their daily cash balance. It is not their money. They should never consider it like, oh, I can use this money to fund my second restaurant.
Mm-hmm.
Where things starts going wrong. And when you get into that discipline, you only add up three accounts, like how much money you have to spend without the sales tax.
Mm-hmm. And what happens when, for whatever reason, we fall behind? So now sales tax time comes, it's quarterly, and we're short. How do we deal with that other than just, praying that we have a better next quarter? Is there something we should be doing proactively to talk to the Department of Sales Tax?
Yeah, so I think the sales tax, we can definitely talk to them. Probably first time they can let you go, get away with the murder, but not the second time. So it's this is like not your money. You should not use it. And if you have done it, then course correct it fairly quickly within the next 90 days, and make sure you don't repeat the same mistake, because after that the penalty and interest which gets into it, it's going to break, the whole business. And also you might have part of your operating agreement, you are also not comply with the investor agreements what you have with the investors.
Mhm.
Has other implications too.
And is there a way to deal with income tax? Do you work with clients on tax planning? Should they be taking some portion of their earnings and also putting that in an account?
No, we do not provide that service yet.
Okay. We have a question from somebody. It says, if we're actively looking for a space, would you recommend creating the LLC, even if finding the space might be 6 months out? No, you don't need to. We can form an LLC in about 24 hours.
Yeah.
But if you're doing business in that LLC, you're raising money, you're spending money. It's not a bad idea. It's not a very expensive thing to do. So it kind of depends. But if you're sure that you're going to find a space and you know the money's coming in, you might as well set it up. You agree with that,
I,
Nish?
I, I agree with it.
Okay,
Absolutely.
good. Thank you. Thank God. Next. So, um, setup materials. Okay. This is our restaurant's infrastructure. We need to open up business-specific bank accounts. We need to secure insurance. We need to get the POS and the payroll platform set up. We want to be using accounting software from day one and create a restaurant-specific chart of accounts, of course. So why don't you take us through that? Let's talk about banks first. What should an operator look for when choosing a bank and what kind of accounts should they open?
Yeah, so I think some of it which we discuss is, what sort of bank accounts they have. We definitely strongly suggest having this four, because frauds are very common with the checks. So payroll, we like to keep it separate. So if you're using ADP, Paychecks, or Toast as an example, you
Mhm.
won't manually write any checks. So by that way, your payroll account is always remains secured. Checking account is one way where you can also use positive pay to protect the business from the fraud. Uh,
Mhm.
so that's the typical banks. We generally like to go with one of the big banks, if possible. However, there are some places where the community banks probably are offering good loan as well in a time to come, or they have a strong relationship with one of the investors. where they have a preferable terms. So that is, depending on most of the business cases. Insurance, I think this is a great point, and this is one place where if you're opening in Miami first time, you'll be surprised how much insurance cost can be added, especially if you're on a water. You have
Mhm.
a wind insurance, you have a glass insurance, you have a flood, a flood insurance. So those are like very critical as part of overall your due diligence. Payroll processing and point of sale, depending on how they like to, use which company. But Square is another like upcoming, solid as an operator, or Toast is, which also now people are using it. And utility vendors, it's a monopoly, so you don't have any room to pick and choose. And accounting software is where the growth mindset also kicks in. If you are planning to not open multiple restaurants, then you can get away with simple accounting softwares like QuickBooks. But if you're opening a QSR and fast casual, something like Restaurant 365 may be a way to go.
Mm, interesting. Okay. Um, Talk to me about a little bit about payroll companies. What's the best way to handle payroll, and what services should you require from these companies? And one of the reasons I'm asking is because we see a lot of wage and hour claims
Mhm.
and lawsuits based on oftentimes payroll companies not doing things the right way. So what are you looking for?
Yeah, definitely. So apart from, they are not doing it correctly, I think key would be is that should be an internal mechanism of doing a quarterly reconciliation, which whatever payroll reports the payroll companies are filing, tying back with your internal system data, which is point of sale, or, your scheduling. So that is the key, and not wait for something to happen. And then it becomes a pacing game between the payroll company, which you
Mm,
might also end up changing it. So that's even more difficult to go afterwards.
okay. Last question on this. A lot of times our clients fall a little short and they need a little money. How do you get a line of credit with a bank, and how important is it to set that up from the start?
So if you can do it from the start, that is preferable, but not a lot of banks have an appetite to give a line of credit unless it's secured with a personal guarantee.
Mm,
So that is always difficult. The other option is go through SBA loan. Again, that requires a personal guarantee, but you can get the money at a fairly lower rate. And third is like, something like in kind, and other platforms which now lending the money at a slightly higher interest rate is it is a third way to raise additional capital while you are still building a business.
As a bookkeeper for restaurants, do you like them to have this access to extra money?
Um, Honestly, no, unless it is required. You don't want to get comfortable just because you have a cash and then you are not fine-tuning the business. It's
Hmm.
important to ask question like why my food cost is 32% and not 30%, because that 2% is equivalent to $100,000 in bottom line if you're doing a $5 million business. So I think it is more critical on making sure you have a run oil engine than having a spare cash in the bank account.
No, it makes sense. Let's talk a little bit about vendors. They're a huge part of our industry and our day to day, whether it's Baldor or whatever your meat or fish guy. How do you deal with vendors? What is the best way to deal with them? Forget about the linen guys because they're their own problem. But your usual other vendors, how do you build partnerships with them? How do you set up a payment system that will work? What are some tips and secrets to getting that right?
Yeah, I think first day it's always difficult to get the credit. So it's like they probably like to see the first few payments to come in maybe in advance, unless you have a relationship prior to opening the restaurant with the vendors. You can easily get into 14-day to start with, and then eventually it can go up to 28 days. And then, time to time have a very honest conversation. If you are running into, potential, sort of a headwinds, like, hey, I need help over the course of next 1 month in the month of August or September. So that's all it matters. It just requires a clear communication and transparent communication, instead of like dodging the calls and then you go into COD and all the other, pitfalls.
And if you do get to a point where you have terms with vendors, what are the best terms for just operating your business?
So operating the business in a sound manner, you don't want to go over 30 days. There are vendors you can stretch it to 45 days or sometimes even 60 days. But that means your cost of getting those goods already include that interest and the risk element. So if
Mhm.
you are paying higher, cost of goods sold to the vendors because they are taking that into the factor.
And is there any way to negotiate discounts with vendors, and how does that work?
Yeah, so we have some clients where they like to pay every vendors weekly. So whatever they bought, as of this Sunday, they like to pay every Friday. And they use that as a leverage to improve a bottom line, but also the
Mm.
cash flow. So that is the one way to do it. Second way is if you are running a high volume restaurant, and let's say I'm just giving an example, black cod or bronzino is your top selling item, you can actually fix the pricing for that for next 6 months by committing a minimum volume to the supplier or a vendor, and you can actually lock that prices for you. So you don't have to see, like as like sort of a commodity, driven pricing.
So they'll lock it in for you if you commit to a certain
Okay.
buy.
Yes, yes.
Huh. And how much of a discount can that run?
That can go anywhere around like 6%
Oh,
discount.
that's amazing.
Yeah.
Again, so the vendors, food costs is such a big thing for the industry that we're always trying to figure out how to do it the best way. Are there reports that we should be running every week? And if so, what do those look like when it comes to our food suppliers and our beverage suppliers?
Yeah, so food suppliers, you want to look at week over week variation along with your inventory, because you don't want to buy a lot, like let's say last week when your revenue hasn't moved that much versus previous week. And if that is happening, then you anticipate might be a wastage is going to kick in or your food cost will go high. So it's like looking at that on a week to week basis, how much you bought last week versus last week. And if the revenue has been the same, then you should ask those questions to the purchasing manager that, hey, why did we end up buying extra $10,000 worth of food from Baldur, which you most likely might not end up using it on Monday, Tuesday.
Mm. So every week, just to stay on top of it.
Yes.
Talk to me about delivery platforms. We are involved with a lot of these platforms. A lot of clients say we do it because we have to, not because we're really making money on deliveries. Is that true? Are you seeing that restaurants are not making money from deliveries?
Yeah, it is a necessary evil, unfortunately, David. Most of the restaurants don't like it, but they have to just do it to stay relevant or, get their, food out. But yeah, making money out of it is not easy. What we suggest is like try to limit those platforms to like 2 to 3 and not have like six, because then you are actually getting into more complexity than anything.
To limit it to, can you say that again, to a couple of different items?
Yeah, so limit those third-party delivery platform to 2 or 3 and not like more. We had client who had like 8, 9 delivery platform. That's where it becomes even more
I
loss-making.
see 2 to 3 platforms.
Trying to manage all those platforms.
Do they ever make money?
Very little, very little. It's definitely not a big driver from a bottom line perspective.
Have you seen any restaurants employ their own delivery system? Is that better?
So there are some white label platforms, but then you go into workers' comp insurance exposure. So that is the caveat to it. If you are at a scale where you can afford to do that, then you like I would say maybe 2% of the clients are doing it. Otherwise, everyone is preferring outsourcing this.
Gotcha. Okay. Let's talk about, well, best practices is a big topic. Labor and employment and legal compliance we can do on a separate webinar also. Um, Talk to me about tracking all expenses. Lord knows that's important. What do you mean by that? And what is the best practice for tracking?
Yeah, so tracking, if it's a simple restaurant, we definitely like to break it down into the key chart of account. We like to follow Usale chart of account model. So when you look at the P&L, you get to understand where exactly the money is going. But if you have a complicated business, you have a rooftop, you have a coffee shop, you have a restaurant, you have events, then you want to classify expenses by each of the revenue center or a cost center. So you
Mhm,
understand what is a per square feet, profitability or a revenue for those places.
mhm.
So it is important. At the same time, if you are transferring the lemon from kitchen to the bar, you want to record that. Otherwise, your food cost is going to be high. You will end up crucifying the chef while the beverage is, making a solid gross profit, which might not be the case.
And so that leads us to inventory. How do you suggest that an operator conduct regular inventory checks? Is there software that should be used? Is there bar software? What's the best way to control that? Because that really does ultimately control food costs.
Yep. So yeah, before COVID, we used to suggest clients to do weekly, but because of labor and everything has gone up, some of the clients have moved into doing inventory only for high value items, which is basically your protein and chocolates or any expensive items you have it on the menu. And it's like 80-20 rule, right? If you do that 20% right, your food cost, you will have a good understanding of your food overall food cost. Wine, we definitely, if it's a fine dining, let's say Italian restaurant, we definitely suggest to do it weekly because missing a bottle of Brunello or Don Perignon might be a pretty expensive mistake or not to find. There are many softwares which are available, which restaurant, depending on where they are, they can use it to do inventory, whether it is craftable margin edge or get me's as an example for great recipe costing. So those all are available, or within accounting software, you can also use R365.
Mhm. Someone's asked the question of what is Nish's preferred tech stack? Do you have a preferred POS? This will be rapid fire. Preferred
um,
POS?
yeah,
Which
go.
one?
Yes,
Which
I don't have any preferred POS. It's like you have a haters and lovers for all the POS and the payroll company as a figure of speech. So people who love ADP, people who hate ADP, people who love Toast and Micros, and they also hate at the same.
Yeah. How
So
about third-party delivery? You got a favorite?
now there are only like two left, Uber Eats, DoorDash. They are the main one which we see in most of the places.
How about liquor inventory?
Um, Margin Edge.
Okay. What do you like them?
It's a pretty easy software to do. It doesn't have so many of bells and whistles where you get lost into enterprise version of inventory software. And I think what we believe is restaurants just need a very simple software and not like 1,000 features because they are not running a casino, right? As a figure of speech.
Hmm. Last question for this particular topic. What, how often should an operator be reviewing financials, and what does that actually mean? What are they reviewing to stay on top and to be able to make adjustments when necessary?
Yeah, so every week we definitely like restaurants to look at their prime cost very, very closely. And if you are actually looking at it, with a very military precision eyes, you will not go wrong on a monthly P&L basis. So weekly cadence on looking at the average check, covers, no-shows, reservations, which are some of the non-financial factors. along with the food cost, beverage cost, and the wage cost are the key. And then every month we like to sit down with the restaurants and go through line by line and see what went against budget, what changed versus last month, and what changed versus last year, so we can course correct as we go.
Hmm. Great. Last topic here, and these are benchmarks and measurements for success. If you could just rattle off these key metrics because they change over time and things have changed since COVID, especially, and since labor and cost of goods have gone up so dramatically. So give me a range for, let's say we're talking about a 75 seat Manhattan, not fine dining, but mid-range restaurant. What's what's a labor cost that we should be aiming for?
Good business would have around 33% labor cost.
33. Okay. Cost of goods,
Blended between food, wine, liquor, it should be around 28%.
28. That number hasn't changed over time. Profitability, do you mean net profits percentage?
So yeah, EBITDA should be around like 16 to 18%.
16 to 18%. That, my friend, would be great.
Yes.
It's a rarity these days.
New
People
York, it is a rarity. Absolutely.
people are scratching to get to 10. 15 used to be the number, but yeah, it would be great if we can do more. We do have two upcoming webinars, then we're going to take some questions that have been asked of us. The next one's going to be starting a hospitality group, which I have been proposing and a proponent of for a long time because mom and pops no longer can survive. So opening multiple locations and thinking about your restaurant as a business with arms that can grow into other things, and then also licensing and franchising. So here's a question, and we'll let you know about those. We'll send out some notices. Here's a question.
Mhm.
And I think this is maybe for me. If we're planning to have a small restaurant, less than 30 seats, in which the owner will be the primary person running the front of the house as manager and server, how can we approach this with regards to New York labor laws not allowing employers to take tips? In order to receive tips, should we consider having this person structured as an employee and not part of the LLC? If they are part of the LLC and they are an owner, they can't take tips unless they're the only person working, which is not going to be the case because you're going to have a dishwasher, you're going to have uh, wait staff and some front of house staff and probably back of house staff too. So if you are an owner, you cannot take tips, period, end of conversation. If you don't want to be an owner and you want to be an employee, that's fine, but you can't share in the profits and you can't be a ghost owner. So be very careful about that and call me if you if you want to discuss it further.
It is a landmine. Yeah, absolutely.
Yeah. Um, well, I think we're just about up. We've got 2 minutes left if anybody wants to ask some questions. Nish, I really could have talked to you for hours. I think this has been incredibly informative, really helpful to our clients and to all operators. I can't thank you enough. It was a great, great conversation. Thank you.
No, David, thank you, and to the entire team as well for putting this. And everyone, thank you so much for joining as well. Really looking forward for the next one.